Hi, welcome to the Devon webinar. I'm your host, Greg Smith, Head of Retail here, and we're joined today by Patrick Washer, who's the Portfolio Manager for the Devon Dividend Yield Fund. Welcome, Patrick. Good to see you. How you going?
Good.
Excellent, excellent. Well, look, obviously we're in the throes of earnings season. There've been results coming thick and fast on both sides of the Tasman, so we're going to dissect a few results. Start of the week, we had Freightways. It was initially a positive reaction. What did you make of the results?
Yeah, so Freightways is a company we really like. We think it's really well managed. For instance, it's been listed for around 20 years. They've had 2 CEOs, and a good way to measure the quality of a company is capital efficiency and the return it can earn on the invested capital in the business. Freightways continue to have a capex to sales ratio of about 3%. Meanwhile, the return on their invested capital consistently through the cycle over 20 years ranges between sort of 15 to 20%. So this is a really high quality business. However, they do have certain ties to the economy. What they predominantly do is move parcels between businesses and businesses to consumers. And obviously that has certain ties to economic activity and things. And what we saw during the result posted on earlier this week on Monday was quite a solid outcome whereby same customer volumes were down 5%. However, their sales team and things are really effective, and they're able to grow revenue by 4% with new market share gains to help offset that. And then when you layer in certain pricing initiatives, we ended up with an outcome where revenue was up 7% and operating earnings were also positive.
And obviously very different. Some people get confused with Mainfreight, but obviously very different businesses. Main competitors, New Zealand Post, right? So how do you see that all playing out going forward?
Yeah, sure. So I mean, in respect to that, you know, the similarities sort of start and end that they have freight in their name. They're very different businesses. And what you've had is the courier market in New Zealand used to be a 4-player system with NZ Post, Freightways, Aramex, and PBT, Peter Baker Transport. Recently, NZ Post has bought PBT, and Aramex is currently struggling with some driver issues and profitability and things. So what we've had is consolidation into 2 players. Both players are incentivized to act rationally and raise prices. For instance, it costs, say, $3 to move a package around Auckland on a metro route. Now, that price hasn't really changed in 20 years. And following the millions of dollars NZ Post has invested out in Highbrook on new automation systems and things, they're driven by Seymour and other government officials. They're being incentivized to earn a return on that investment. So what we're seeing are prices and thus profitability of the sector lift, and that provides a real earnings tailwind to Freightways.
Right, interesting. And then so turning to the next company, A2 Milk. Now, I'm sure you won't mind me saying the Devon investment team did very well at A2, getting into that stock towards the end of last year. Obviously, it's been one of the best performing stocks on the New Zealand market this year, but a negative reaction to the result earlier in the week. What can you tell us about that?
Yeah, so from the start of the year to the day before the result this week, the stock rallied slightly over 70%. Now, on the day, you may have seen the share price was down nearly 20, it was down 19%. And that was largely due to expectations not quite being met. So they still delivered a solid result, and their outlook was for mid-single digit revenue growth. The issue is, though, is that once the stock has rallied 70% over 8 months, expectations were quite high. And those weren't quite met, reason being that while the outlook for the next sort of 6 to 12 months for Chinese, the birth rate is quite positive, they're somewhat constrained by the amount of infant formula products Synlait can give them for one of their branded labels. And that just means revenue came in a bit softer than people were expecting. However, the result they just posted had 9% EPS growth. So things aren't all bad, it's just an expectations thing.
Sure. And interesting in the Chinese market, I mean, how do you think they're doing? Obviously, the market's shrinking, but they seem to be taking market share and I think premiumizing the product effectively. Is that right?
Correct. So A2 to date predominantly plays in the premium end of the market. And what we've seen since really the 1980s is a steady fall in the birth rate. And that's been accelerated, I guess, through these COVID years due to some local policy and such. And what we've seen is the broader China infant formula market shrink in nominal terms. However, over the recent, say, last 2 years, A2 has actually been able to successfully grow their nominal exposure to that. So they've been able to grow in a market which is shrinking. And that's largely a credit to the work the CEO has done and certain other senior leaders based in China and elsewhere. And they really now have certain investors on the call may remember Daigous. These are predominantly students and such across Australasia that over messaging apps would take infant formula and ship it back to China. That now no longer is so pivotal to the business. They have much better control of their end markets, being that they sell directly into China through their various channels. What that means is that the company has better control of inventory, and then they have better control of prices. And we don't get this whipsaw effect that investors may remember of the A2 of old. And as a result, what's happened is since 2021, A2's market share was around 5% of the broader market. Today, it's over 7%. And that's a credit to effective marketing strategies, control of these channels and things. So they're doing a good job, all things considered.
Excellent. Well, anyway, and well done on the selection of A2. Yeah, obviously you've done. It's been a good performer for the team. Now, sort of moving on, Fletcher Building been in the news. Obviously, they've got a new CEO finally. Haven't got a chairman yet, but obviously they had a result. What did you make of that? Obviously, a lot of moving parts to it.
Yeah, so Fletcher Building is a really interesting one where inside Fletcher Building there's many really fantastic businesses. For instance, the wallboards company commands well over 90% market share. They've just got their brand new site down in Tauriko, just outside Tauranga. These are really high quality businesses. However, the share price has been really under some pressure due to a range of issues around Iplex pipes, which some people may be familiar with. These are pipes in predominantly Western Australia, which tend to sort of burst, and that's created some issues. However, pleasingly, in their result a couple of days ago, the company signalled clear sort of movement towards an industry solution, which is a positive, and they think that they'll be able to achieve that by their AGM in September and give investors more certainty around what the outcomes are. So that's a real positive. If you think about some of the other issues that the company's been faced with, the road Puhoi to Warkworth is now fully completed. Moreover, the NZ ICC, the NZ Convention Centre, which caused the fire as it was approaching handover, that's going to be finished within FY25. So we're approaching the end of things. However, to your point, investors were underwhelmed with the guidance the company offered. So Fletcher Building is currently expecting volumes in their building products and distribution businesses to be down 10 to 15% for the year ahead. Now, while this is a negative, we are clearly approaching the end of the building cycle. And as credit conditions loosen with the OCR coming down, banks make it easier for first home buyers to get their first mortgage. That greases the wheels of the whole property cycle. And then we'll see a volume recovery come in due course. But yeah.
Interesting. So yeah, like potentially leverage to that trough if we're at that trough in the.
They are. Yeah, we're approaching the trough, and the company has had a lot of issues. However, we're also seeing them successfully mitigate them in many respects, and the hope is that a new CEO will be able to really take some authority and try and move forward with these issues.
Sure. And having a CEO now finally might mean it might be a little bit easier or expedite the process for getting a chairman potentially.
Correct. Yeah, it's always a bit of a chicken and egg. Ideally, a chairman appoints a CEO. However, I think they had to deal with what presented with them. Like what they were presented with. So we have a new CEO. He has some industry experience from previously working at Fletcher Building and in the Rank Group umbrella with Carters and things. So yeah, we're optimistic.
Excellent. Well, thanks a lot for your thoughts, Patrick, and taking time out to cover those earnings. Obviously, they're coming in pretty regularly. So, look, we'll end it there, but we will be back next week to talk about some other names that will be reporting over the coming days. But thanks for tuning in. If you do have any questions about what we cover in these webinars, or indeed you'd like to see something else covered, do email in. You can reply to that morning note or email inquiries@devonfunds.co.nz. Otherwise, we'll leave it there. Have a great day. Have a great rest of the week. Bye for now.